The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva, they've got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. S&P 500 now down 98.99 and falling. Let's take a look and see what's going on with the 10-year Treasury. That's down 6 basis points. Mortgage-backed securities down 8 basis points. We'll take a look and see why that's happening. But every day at this time, OB, MMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. What did loans lock at yesterday? Don't know the points, don't know any of that other information. I just know the amount that they locked at according to OBMMI, again, with their 35% market share. 30-year conforming, 6.308, up just a little bit. 30-year jumbo, 6.402, up a little bit. 30-year FHA, 6.339, up a little bit. USDA for the rural areas, generally with no down payment, 6.297, down ever so slightly. And the best loan on the market, the 30-year VA loan at 5.973. That one was down a little bit as well. So we're going to take a look at all these things, but we want to know, why is this happening? Anybody can give you the numbers if they know where to find them. But as anticipated, the Federal Open Market Committee, FOMC, hiked Fed funds rates by 50 basis points to a target of 4.25 to 4.5. This is up sharply from where rates were only 9 months ago in a range between 0 and 0.25. In their statement, the Fed said that ongoing increases would be appropriate and that they would continue to their balance sheet reduction. The surprise was in the Fed funds rate outlook, where 17 of 19 members forecast a Fed funds rate over 5%. Ow! The projected terminal rate, or the highest the Fed funds will go in the cycle, increased by 50 basis points to 5.1 from 4.6. The market initially reacted negatively to this news because it signaled that the Fed intended to keep rates higher for longer than anticipated. Sentiment shifted during Powell's Q&A when he acknowledged that the, quote, inflation data received so far for October-November shows a welcome reduction in the monthly pace of price increases, unquote. Does that surprise anybody?
Surprise, surprise, surprise.
6 months ago, we were looking through the windshield, not the rearview mirror, and we told you that that was going to happen on the November report, basing that on October data. The December report, which is November data, we've been telling you that for 6 months already. Unbelievable that Powell can't see these things, but then again, he's only looking in the rearview mirror. Initial jobless claims, which measures individuals filing for unemployment benefits for the very first time, fell 20,000 to 211,000, lowest level since September. Continuing claims and those that continue to receive benefits after their initial claim rose again, 1.671 million. They have now risen 9 weeks straight and are at the highest level in 10 months. This 10-month high in continuing claims points to a potential slowdown in the pace of hiring. Once again, there's no surprises there. Retail sales, this is what drove the market down today, decreased by 0.6% in November, which was weaker than estimates of a 0.2 decrease. Core retail sales fell 0.2%, which came in significantly under expectations of 0.8% gain. So at the holiday season, people are slowing down their purchases. Not a good sign for the market. That is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva got the programs and the products. You just need to make the call, 800-306-1990.